Hello, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. I want to welcome everybody to the Daily FX Walkthrough. We're going to get started in just a moment. What I'm going to do tonight is walk through the latest technical report at DailyFX.com. So let's go ahead and pull up DailyFX.com and Jamie Setley's most recent technical report. This is a report from Friday. The euro is holding above short-term support lines. Staying above there keeps recovery scenario firmly on track. But let's go ahead and scroll down to the dollar-yen, as that's what we have been following. If you recall, Jamie said on Thursday the dollar-yen has reached a 38.2 with the most recent five-wave drop, not shown as the break above the short-term trend line. This development suggests a larger correction, perhaps to the 61.8 at 103.44, is underway. So let's pull up the charts, and again, this is the charts that we were viewing on the last report. First, I want to that was the daily chart, but first I want to start off with the hourly chart. And if you recall, on the last report, I was mentioning that there was a very long candle wick, and let me see if I can highlight that for you. That would be this candle right here. I could switch the style so you can see it a little more clearly. This candle right here, and to have a slight bullish bias against that low, as Jamie again was calling for corrective action. Again, that would be a counter trend rally up to that 103 area. So far, that analysis has been spot on by Jamie in terms of calling this correction, and that technical signal, that long wick, has also held true. We can see a slight consolidation after that wick and then the subsequent rally. So what do you do now, as prices are a little bit too far away from that low to justify a solid risk to reward trade here in terms of a short-term trade, again, which would be against the overall trend, which I wouldn't recommend for newer traders. But if you are a short-term trader, what we might do at this point, there are two things that I might suggest. One is to keep the Bollinger Bands up and look for moves down to the lower Bollinger Band, possibly for an entry. Again, we want to place that stop right beneath the low of that candle wick. So that would be the basis of our risk to reward in the trade. The other thing we can do, if I zoom in a little bit, and again, this is short-term analysis. So, in terms on longer-term charts, our indicators are much more reliable. On shorter-term charts, while the indicators can work, they're not as reliable, and you have to be able to abandon your analysis right away if the market's not adhering to your specific technical level. So here's another thing that we can do in terms of simple, very short-term support line. See if prices come down there. Maybe look for an entry just above the line with a stop, maybe 30 pips or so beneath the line. But again, this is a little more aggressive than waiting for a move to that lower Bollinger Band. But as prices maintain this level here, you'll start to see that Bollinger Band move upwards. Ideally, what we might see, let's say maybe 6 or 7 hours ahead right now, is for this Bollinger Band and this support line to converge, at which point that would be a much better confirmation of that support line. So that's something we can look for going into tonight and into tomorrow. And the other thing I wanted to mention also is the daily chart, and where this corrective rally could be headed would be to that 103, just above that 103 area, which is a 61.8 fib, and also the breakout. We had the breakout beneath the 103.50 area, and we can see resistance on that first candle, and we might look for resistance in the future as well. Again, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. Thanks for listening.